big dollars floating around here, right? That's why this is something that uses up a chapter. It's not an insignificant part of what goes on, and as the world economy continues to grow, it gets more and more. So what do we have? $3.2 billion. How often? Every day. Now that's some trading volume, right? Now, what was the deal on the flip side? Let's talk about the two tables to make sure we got an idea of what's going on here. How does table 10.2 compare to table 10.3?
Doesn't it just break it up by country?
Yeah, it's yeah, it's kind of specifying markets,
Where
right?
the trading's being done.
Yeah, where the trading's being done. So on the first page, what are we looking at? Yeah, the currencies that are being used, right, for the trade. So that's where we've heard the dollar is kind of the main player in the currency markets around the world. So the dollar is kind of the standard, and we kind of see the power of that just from the volume of trade. If 86% of the total trades involved dollars. Now, they also pointed out the 200%. All right, we got other, if we add these all up, is it 86% our dollars? That's kind of a weird thing if you look at the math here. They mentioned it in the paragraph about the 200 versus 100.
Right.
How does that math out? On the front page, if you add up the composition of currency trades, it says percent of total trades. Well, the U.S. is at 86%, 37%, 16.5, 15. If you add all those up, I thought it was supposed to be over 100 to equal to 100, but it's actually equal to 200. So what was that picking up on?
Every exchange counts as a purchase and a payment.
Yeah, it's kind of one on the other because you always got the two sides of the coin. So there was actually a kind of a double volume. Like if you were trading the yuan for the dollar, it counts for the yuan, it counts for the dollar. That was one. And so the volume's a little bit different. And that's what we saw with the demand and supply shifters when we did the market, right? That what shifts supply also shifts demand. And so there's that symmetry going on in the currency markets that's a little different. And then on the back side, we've got the United Kingdom doing the vast majority of currency trades. And they're one of the largest traders of US dollars for that matter, which is again kind of weird. But it's highlighting for us that this is a subsection of total volume of trades going on, right? So if we are, there's lots of dollars being exchanged in the United States that is just dollar for dollar. And so it's only a small subsection that takes place there. And it even makes kind of a little bit of sense that it takes place in other countries that are using the dollar as a medium of exchange in a sense to a higher degree.
Does this take
than
into
other
account like
currencies.
Forex trading and stuff like that online?
Forex.
I guess it's time trading. Or,
Oh, is that the thing you did on your presentation?
Yeah.
Yeah, what was that again? Refresh my memory.
it's just currency trading online, like
Yeah, it does.
facilitates online.
Yeah, that was
Okay.
part of the, yeah,
Because
part of this trade volume is
Where are the
that.
geographic locations if it's online though? You know what I'm saying?
It's all cleared through a physical market somewhere. So that server, you know, it's online, but the server is housed somewhere, and there's somebody that's a registered agent that has a physical location. Yep. Okay. So anyway, that just kind of gives us a feel of what we're getting into with this material. Any other questions or comments there? Let's see, what did we leave off with last time? Was it the shifters? Okay. All right, so we did the supply, we did all the supply shift. There was just 3 of them, right?
Yeah,
All right,
3.
and so the last thing we left off with is that 2 and 3 are equal. Okay, so I think what we'll start off with today is Well, let's see, which one should we do? Yeah, let's do this one. So I want to recall from chapter. What's this thing? That one.
10, right?
The chapter?
That we're doing right now?
Yeah, 10. Recall from chapter. I'm not sure what chapter. 4 maybe, in terms of trade, and recall the terms of trade. What was that concept way back from chapter, I think it was 4, whatever. The first, when we started talking about the Ricardian trade model, and we had wine and cars, or beer and coffee, or whatever we had. What was it? The world price, right. So this is just the world price. And how was it expressed in that chapter when we modeled it? How did we talk about the world price?
It was whatever good and for the other good.
One good for the other, yeah. So we had 3 cars for 1 food, or we had 5 wines for whatever. So it was a good for good price. So it was the world price expressed in terms of quantity for quantity. So for example, 3 cars equals 1 unit of food. And so we could think of the terms of trade. What do we call that? TT? Different notations. I think that's what we have. So we had 3 cars for every food, or we could also think of that as a third of a food for every car. We could invert that. But we were always talking about the quantities. Okay, so what I want to, that concept is in this chapter very similar to what we call the real exchange rate. So comparing that to this chapter, now chapter 10, we're going to look at the real exchange rate, which we'll use the notation R subscript R. For the exchange rate we did last time, we put an N there for what? Nominal. So the nominal exchange rate. All right, so the real exchange rate is getting back to this type of concept. So let's just do a little example. If the nominal exchange rate is 100 yen per dollar, and the price of food in the United States is $90,000 for every food, and the price of a car in a foreign country, let's say Japan, is equal to 3 million yen. 3 million yen per car. What is the real exchange rate? So the nominal, the spot rate, as well, I guess I haven't used that word yet, but we're going to use that a little bit later. The exchange rate's 100 yen per dollar. The price of food is $90,000 each unit of food, and a Prius runs 3 million yen.
So we need to get the price of food in terms of yen per dollar, right?
Okay, yes, we want to convert that, right? So if we're thinking about the relative price in our country of one good versus the other, we need to do a little conversion and solve it out. So play around with that, see what you get. Play around with the numbers here. What's that?
You guys ever do it solely on the amount of production?
Yeah. So if I bring the car over to the United States, I can start to create the relative price, what I can buy one good compared to the other, right? So we've done this before with in micro class. If we think about the price of a Mountain Dew is $2.25, and the price of a Gatorade, since Ethan's got a Gatorade, let's just say it's $1.75. So if I take the price of a Mountain Dew divided by the price of a Gatorade, I can come up with the relative price of one good versus the other in terms of the quantity exchange, right? So this is that fun little trick we do in economics. If we now take $2.25 per Mountain Dew and divide it by $1.75 per Gatorade, somebody pull out a calculator. What's that? 225 divided by $1.75. So got this little thing here. I'm gonna calculator it up.
You don't want to thumb really fast.
That's okay. That's my trouble.
1.28.
1.28. And is it 1.28 Gatorade per Mountain Dew or 1.28 Mountain Dew per Gatorade? Gatorade per Mountain Dew. So take the denominator, flip it over, multiply it times the numerator, right? Dollars cancel. We've got for every, and is this the price of a Mountain Dew or is this the price of a Gatorade? What would you call this? The relative price of a Mountain Dew or a Gatorade? Mountain Dew, right? Because one Mountain Dew costs you how many Gatorade? 1.28 Gatorade. So a fraction of a bottle. Ethan, if you want to hold up your prop there, he needs to give me 1.28 of those for me to give him this, right? Because that's what our internal market system is telling us what Gatorade and Mountain Dew can be traded for. 1.28 Gatorade equals 1 Mountain Dew. So now what we're doing is we're kind of thinking about the global marketplace. The only thing standing in our way is that we've got different currencies that we can trade them at. But we can now think about the relative price of a car or relative price of food in the United States. Okay, so let's kind of do the same exercise, except that car is coming from Japan now rather than some American-made car. But we're going to do kind of the same thing. So the real exchange rate is equal to the nominal exchange rate times the price of food all over the price of a car. Would be one way to knock it out. Let's see, did I do that right? Actually, I got yen per dollar. I wanted to do that the other good around. Since we've got my yen per dollar up there, sorry. The price of a car over the price of food. So I take my 100 yen per dollar, multiply it times my $3 million, whoops, I screwed that up again, didn't I? I was right the first time. It's all right, I should just follow my notes a little bit better here. You guys are going to have a butchered up thing here. All right, there we go. All right, let's just start this little exercise over here. The reason this is a little goofy is, remember I told you that we flip it around in the other way of doing it. All right, so maybe I need to do 100 yen per dollar. That's right. And then what are we converting? We're going to convert our $90,000 price of food at dollars per food all over the $3 million yen per car. Now we got all the pieces, which is what I started with. Sorry.
How'd you know to do it that way?
Well, you can do it anyway. You can. So we're going to look at the answer and see what we came up with.
Okay. I'm just saying, like on a test, how I would recognize it to do that.
Well, I'll get to it once we get it solved out. And it kind of comes back to our Gatorade Mountain Dew one there. All right, so what do we get for an answer with all this craziness? 3. So the dollars cancel here, right? So we end up getting 100 times the 90,000, giving us our $9 million. I guess I'll put 9 million. 9 million what yen per food, all over our $3 million yen per car.
And then becomes car over food.
Comes car over food, good.
3 million car.
So 3 cars
Cars
per food. That whole thing collapses down.
Yeah.
The millions drop. The yens end up canceling. We do the flip of the denominator. And so we got 3 cars for every food. Now to get to Max's question. Is this the price of a food or the price of a car? Price of a food. How do we remember that one? What you guys? Some of you guys got it. I think some of people are a little questionable on. Do you just memorize that it's either the numerator or the denominator?
Yeah.
That's usually a bad way to do it, honestly. Whatever's the one, right? Because when you go to, so this will be easier to memorize, honestly. When you go to Walmart and you buy a bottle of shampoo, it's for one shampoo, right? So whatever the one thing is, and if you tell your story of this is 3 cars for every one food, oh, that's the price of a food, expressed in terms of the other good. Yes. So that's the thing that kind of keeps you on track a little bit better. All right, so that is the relative price of food. It's the real exchange rate. The real exchange rate is 3 cars for every food. All right, so
The relative price of a car is 1/3 food.
yes, yep, yeah, you just flip it over. Yep. So yeah, what is the relative price of a car? I guess we flip that over. 1/3 of a food per car. So that is that answer technically. Okay. So that'll maybe come together a little bit better as we think about the real world, believe it or not. In reality, there is a basket of goods. So we're not really talking about just one good, cars and food. We've got all the goods that were being traded. Or we can even get back to thinking about the whole real GDP as a potential something that could be traded or purchased by a foreign person. So there's a whole basket of goods. And so the real exchange rate is actually equal to this equation. I'm going to do it 2 ways. I'm going to do it in 2 steps so that you see that it's just like what we just did, first of all. The nominal exchange rate times the price level, not the price of laundry detergent, but the price level, the average level of all prices, because we're really talking about the basket of goods. That over the price level of the other country. So the star again is denoting the foreign country. And then we can just rewrite this expression as the nominal, or the nominal rate times the ratio of the two price levels. Just a different way of looking at it. I think the textbook shows it this way. But this concept comes to us from just doing this little exercise. And a flip way of doing it is to bring this over to this side. So let me just put a big or. It might be helpful to write it as the nominal rate is a function of the real rate times, now I'm going to put the price level of the domestic country on top and the foreign country on the bottom. These are the same equations. All I did was flip the terms around. Yeah, well, we gotta think critically in a couple different directions. So this one highlights a powerful force at play in international trade called purchasing power parity. Purchasing power parity. And that the value at the end of the day should be 1. The real rate of trade should be 1 for 1 if we're talking about identical goods. So instead of talking about food, we talk about a Toyota Prius. A Toyota Prius in China should sell for the same as a Toyota Prius in the United States, right? It's just a Prius, other than travel costs. So let's kind of eliminate travel costs. But and we can talk about things like software or a download, right? Where it doesn't matter if you're in China or in the United States. So if you buy it from a Chinese denominated in yuan, or if you're in the United States and you buy it in dollars, what's going on there? Well, they should be a 1-for-1 trade minus any transportation costs. So well, yeah, and that's kind of where we're going, is to try to determine how our exchange rates, what are some of the underlying forces going on there. So why would we expect the real exchange rate to be 1 for the same goods? Why would it be a 1-for-1? What would keep it in check? In other words, let's take a disequilibrium, if we're calling that equilibrium. Let's say that effectively, after the exchange rates are taken into account, you can get 2 for 1. You can buy, for the same amount of money, you could buy them from China. After taking the exchange rate into account, you could get 2 Priuses for the same price as you would buying them in terms of dollars, right? So imagine that was the deal. Like, gosh, if you just, given today's exchange rates, man, you can go to China and get 2 Priuses. Did you know that? No, I didn't know that. Well, shoot, let's do that. Let's just pretend that is the case. What would a lot of people start to do?
We would definitely be buying Priuses from China.
We'd definitely be buying Priuses from China. We would enter the foreign exchange market because we're holding dollars, right? The demand for yuan would go up. Their currency would appreciate. Our currency would depreciate because they're one and the same. And that activity would continue until that arbitrage is gone. Until that arbitrage opportunity, kind of that free money of buying in one market and selling the other, market forces would cause the exchange rate to adjust so that we're back to a 1-for-1 trade.
Wouldn't supply also decrease kind of more just?
Yes, that'd be a double shifter thing going on. So both in the currency market, both of those things would be going on.
Supply of Priuses would increase.
The demand would be going up and we'd be buying them from there. And so yeah, there might be some other effects in the Prius market causing the Priuses to go up in yuan dollars, right. But I'm even ignoring that. Let's just say that happens instantaneously because the currency markets you saw with the dollar volume of trade, they respond quickly to stuff like that. If all of a sudden there's a buck to be made by flipping kind of what we call pure arbitrage, buying in one market and selling in the other, those sorts of things happen. There's people that are ready to pounce on that are watching the markets. And that's what keeps the markets efficient. Okay, so let's talk a little bit then about purchasing power parity. PPP. If you're in international class, you got to be down with PPP. Okay, so purchasing power parity. PPP, yeah, you know me. All right. Purchasing power parity asserts that dollars will tend to exchange with row currency, the rest of the world's currencies, with a foreign currency. We can use that term. I kind of like using row. With row currency at a rate, the exchange rate, at a rate that maintains purchasing power of a given quantity of currency. Asserts that dollars will tend to exchange with row currency at a rate that maintains purchasing power of a given quantity of currency. Okay, so from our example, if we look at the price of a Prius, we basically expect that the exchange rate applied to the price of a Prius should be equal to the price of a Prius in the foreign country. Car for car. One car should be equal to one car.
Foreign intense exchange rate.
Nominal exchange rate, yep. All right, so
Or it'd be nominal instead of real one.
if we take this equation and divide one side by the other, we get our, if we bring this over here, this ends up being 1. And so the real exchange rate is 1 for 1. Now that's on this identical goods thing, right? So we've kind of got it, notice we've kind of weaved through some different things. We've talked about the relative price, the real exchange rate when we have two goods. Now we're saying, hey, two identical goods in two countries should sell 1 for 1. The exchange rate between those two goods should be 1. And then we're tying that now to this basket of goods and extending that to the ratio of the price levels. Now, anybody remember the quantity theory of money from Dr. Friedman, Dr. Milton Friedman? Yep, it was with the velocity thing.
Velocity is a constant, something else is a constant. Money supply increases always end up with the same percentage as inflation.
The moral of the story is the one to remember, yes. And so the quantity theory of money said that proportional changes, there'll be proportional changes in the inflation rate from changes in the money supply. A 10% increase in the money supply in the long run will lead to a 10% increase in inflation. A 5% increase in money supply will lead to a 5% increase in inflation, right? So there was a connection in the long run for running the printing press will become inflationary. And then there's some short run effects that might be different, but in the long run, that was Milton Friedman's prediction. This now is how lacking a word here, blossoms or changes, affects the world market in terms of currency, is that we start to see that exchange rates are a monetary phenomenon in large part. Because if we believe Milton's theory here on if I grow the United States money supply by 10% and inflation, the price level goes up, what happens to the exchange rate? It goes up, right? So these two things kind of work in concert with each other. Now, remember in this particular textbook, this going up is dollar depreciation.
Yeah.
This is the mind twist, which is different, by the way, than your principles textbook. So remember when we did the graph, it's probably as good a time as any to refresh ourselves. We had the quantity of yuan, and we have the nominal exchange rate. And so if the yuan goes up in value, our n goes up, the yuan has appreciated, meaning the dollar has depreciated. This is the thing that I don't actually like this style as much, but that's what we got. And we can do it. We can handle it. But that's the one thing that's a little bit different. So this equation's right. If the United States pursues expansionary monetary policy, runs the printing press, then it's going to cause the dollar to depreciate on the global scene. The dollar's going to become less valuable. So let me write some of that out. I'll erase and write right here.
The increase in price and the cost by $1, make them not want to buy it.
Yeah, another way to think about it is that we're flooding the world with dollars. We're flooding the United States. So we got the inflation thing down in the United States, right? If the government runs the printing press, there's too many dollars chasing too few goods, and we have inflation. But that means people are holding, there's a lot of dollars that will eventually get themselves into the foreign exchange market too.
Right.
And so we're kind of flooding it with dollars, which cheapens the value of the dollar, drives down the price of the dollar. So that's the depreciating part. So I'll just rewrite this here. So long-term effects of monetary policy on exchange rates. So I'm just going to rewrite that equation here. The nominal exchange rate's equal to the real rate times the ratio of the price levels. So from the quantity theory of money, this is the Friedman stuff. Uncle Milty, from the quantity theory of money, the percentage change in the money supply, I'll just write it out since we're not doing too much with money supply at this point. Percentage change in the money supply is going to equal the percentage change in the price level. In the long run. Yes. Yeah, so this is kind of a domestic prediction. All right, and changes in inflation doesn't help us out any, in theory. We care about changes to real GDP. So inflationary stuff going on doesn't give us any real benefit from a social welfare perspective. We're not happier because it's 5% versus 10% per se. We care about the real quantities of goods that we have is what gives us benefit in society. So quantitative money says this. And therefore, an increase in the price level from an increase in the money supply leads to dollar depreciation. A depreciation of the dollar. Now we'll sneak in the sneaky part, which is an increase in Rn. The way we have it worked for this material.
Depreciation in the international market.
Yes, in the international market, yeah. On the exchange rates, yeah, because that's always related to exchange rates, yes. John?
So that equation has price level domestic being the United States and price level foreign being any foreign country, correct?
Yes.
But the exchange rate, the RN is dollars per foreign currency. By the way, the book's got it set up.
By the way, the book's got it set it up, yes.
So
So here, let me go back to this one.
Yeah.
So if this is yuan, this is dollars per yuan.
right.
And so if this goes up, if it goes up from if this is 10 to 1 and this is 9 to 1, right?
Right.
So a dollar used to buy 9 and now it's buying 10, right? So the dollar isn't, I'm sorry, I said that backwards, didn't I? So 10,
You're measuring yen.
right, so what's the value of the yen, or I guess I was on yuan, but
Here your ACI along with.
so what would you rather have? 1 yuan buys you $9 or 1 yuan buys you $10? 10. So the yuan has appreciated. Yeah. So that's appreciated. The dollar has depreciated.
Gotcha.
Okay. And that's where it gets. It's especially difficult for me since I do it both ways. So that won't be the last time I'll hesitate on something like that. But so this is correct. The way the book does it here, the nominal rate and the real rates, and the relationship between inflation. So if you want to add on a little extra comment, if you get crazy looking at this, let's just put here, because it takes more dollars to buy 1 yuan. That's depreciation, right? Because from our perspective now it takes more dollars to buy 1 yuan. Okay, so that is a little bit on purchasing power parity. Its kissing cousin is interest rate parity, which is similar to what one of our shifters was with the interest rate.
So interest rates in our country should be similar to interest rates abroad or something like that?
Yes. Yeah, that's basically, yep. So like I said, it's kind of the kissing cousin to this, except dealing with interest rates. Correct. So interest rate parity basically same concept as PPP, but for financial assets with interest rates. And with this, nominal exchange rates, RN, will adjust so that financial assets of the same or similar risk, financial assets of the same risk yield the same expected return considering exchange rate risk too.
So we don't know what the market's going to do. They could change overnight, so set up
Which market?
any market, like.
Well, here we're saying that the exchange rate's going to adjust so that financial assets of similar risk sell for the same price, which is kind of like purchasing by parity because the price of the financial asset is that interest rate or that rate of return. Okay, and so how we hedge against that rate or that risk, this risk can be eliminated. How do we normally eliminate risk in our lives? Diversify would be one. What's the thing we call up our friendly neighborhood person and give them some money and then they take risk away out of our lives? Yeah, insurance, right? So we got an insurance policy. So there's insurance type instruments out in the financial markets, and then you can also buy forward assets for the exchange rate risk. So we've got two types now, the spot rate and the forward rate. So your book just uses an F and an R, same thing that we were using, the R for exchange rate. So we call today, like if we looked up in the Wall Street Journal or we Googled right now, what is the exchange rate between the euro and the dollar? And boom, Wall Street tells us, what it is. Globally, there's a price. That is the spot rate. So the spot rate is the current rate or today's rate. The current rate today. Now, there's people out there that are willing to bet. This is the gambling part of Wall Street. They're willing to bet what they think the exchange rate's going to be 30, 60, 90, 180 days from today. They're willing to put money down because they think they know what it's going to be, and that's the forward rate. So the forward rate is the rate being traded at a fixed point in time via a contract. So this is referred to as a forward contract. So this is the future forward rate. So a lot of times, let's say this might be 90 days, for example. So if you're buying a bond that's paying, you think it looks good, it's a whatever, something in the Eurozone there. German bond that looks good, and you want to buy it, and you need the cash for sure, and you don't feel like worrying about what the value of the exchange rate is going to be. Today, you can also go to Wall Street, and it will tell you exactly what you can lock in for 90 days in the future. And that number fluctuates daily as people enter and exit the future forward market. So we got multiple marketplaces going on at one time. And that's how people start to hedge their foreign exchange rate risk. So corporations that are global do this all the time, right? They don't want to monkey around with, if they have a deal that they're striking in Japan, they're not going to want to monkey around with what's going to happen with the Japanese yen, likely, unless they're in the currency business. But if they're just a normal humdrum business that sells office machines, they're not in the exchange rate market. They just want to know for sure, hey, we got a deal. If I can buy the yen in the future at this, and your deal's this, and this, and this, and this, let's do the deal, right? We try to eliminate some of that risk. So that's what's going on in the exchange rate markets to kind of hedge against that type of volatility and uncertainty. All right, we better call it a day there. We're good.